G'day everyone, welcome back to the video report for the Dynamic Investor Program for April. I wanted to do something just a little bit different this month and reinforce some really critical points about the strategy that we're using. So just a reminder, this is general advice only. So with respect to managing risk, there's a fairly widespread view in the financial industry that diversification is the way to go. And I really want to pose the question whether diversification in investing really does achieve its aims. To me, diversification, so buying into a managed fund or anything which exposes you to a wide cross-section of the stock market and to a large number of stocks, really says to me you can't be bothered about doing the research yourself for individual stock selection. And this theory of diversification as being a way to manage risk, I believe is promoted by incorrect financial theory regarding risk and reward. The theory is that if you've got two poor stocks, that it's less risky than one poor stock, and I really have a problem with that as a concept. So, as was stated recently by well-known market commentator Marcus Padley, and he said it's about buying enough stocks to dilute the impact of your mistakes. It's not about doing anything after you buy the stock, and I think they're terrific words of wisdom. So to me, diversification as a process of investing really guarantees that your overall return will be just around about the market averages, less the cost of fees, because inherently that's all that's going on here. You're exposed to a wide cross-section of the market, and your money is in the market pretty much all the time. So if the market goes down, then the value of your stocks goes down as well. So the alternative, of course, is to buy companies that provide highly attractive and reliable compounding of returns over time. And this is what Warren Buffett has done for the last 4 or 5 decades, and he's become a tens of billions of dollars rich person. And there's no question that he's the foremost investor of our time. And this is the formula that he's used, buying into a smaller number of highly researched companies that provide excellent returns and compounding of returns over time. So the solution is pretty obvious when you really think about it, but it does require some work. It requires plenty of focus, and it requires a lot of discipline over many years. But the alternative is that you don't have to do this individually. You can get someone to do most of that for you and help you keep your strategy on track, and that's really what we're doing in this Dynamic Investor Program. So specifically, the formula, just as a reminder, we're looking to buy companies that provide consistently high return on shareholder funds, that grow profits strongly and reliably, that share that wealth generation with shareholders, and they don't go off wasting that generated wealth on expensive acquisitions or on expensive bonus schemes for management, that also have low and manageable debt levels, and that don't require new capital to grow their business. And that's a really important one, because then you're not being diluted by ongoing capital raisings. So there's the fundamentals that I believe really underpin the difference between the diversification approach, which doesn't really provide very good returns over time, and an alternative stock-specific approach that has the capacity to generate substantially better returns over time, as Warren Buffett has shown us over the last 4 decades. Let's just have a look at a quick market overview. Europe, first of all. We've got over Greece. The market's got to have something to worry about, so it's worrying about Spain at the moment. But look, I don't think it's going to upset markets too much, because the ECB has clearly signalled it's going to provide as much capital as necessary. The US Fed has basically said the same thing. We've got Japan printing, we've got the UK printing. There's a huge amount of stimulus going on around the world. So I don't think it's going to be an issue. Looking at America, money is flowing out of bonds. There's been a 30-year bull market in bonds, and money is now flowing out of that, recognising that perhaps we're heading back into a different era where interest rates may be on the rise. And as a consequence, people are looking for a better return on their money and are less fearful about the capital value of their money. And so they're tending to head back towards stocks and commodities. And we've seen 3 successive months of better job growth in the US, which is a good sign of growth there. The sentiment towards the housing market is improving, although there's still a big overhang of foreclosures to probably work their way through the system. So I'm not really expecting too much in the way of price rises or wealth effect in the US for maybe another couple of years. Let's look at, importantly, with gold, there's resistance at 1810 and then 1920, and then after that it's blue sky. But for me, the trend should be higher from here. We'll obviously get some ups and downs, but I think we've seen the lows in gold. And the gold stock indices in the States, the GDX index and the GDXJ for juniors, appears to be basing to me. So again, I think we've seen the low point in gold stocks, and there's probably only really one way to go. And fundamentally, it would be ridiculous for gold stocks to get any cheaper than they are now. Certainly the quality producers anyway. Looking at oil, it's surprising that oil at these levels has not caused some anxiety about global growth, but at this point in time it hasn't. And it's high enough to promote exploration in the high-risk deep water areas. So more and more oil that wasn't expected to be found is now being found because of those high prices that are able to sustain it. And of course we've got the situation in Iran is also contributing to the oil price. So from an investment point of view, the key areas that we're looking for are resource services area, energy, and industrial companies that do meet the formula that I showed earlier and that we're pursuing. So that's it as a special update for the program for this month. Cheers.